Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Zainuddin and my matric number is 302087. So today I will talk about the differences between Islamic and conventional products. So in my part I will explain 10 points that I already get about the differences between Islamic and conventional products. First of all is the underlying principles. In the Islamic product operating under Sharia principles emphasizing fairness, ethical investment, and risk sharing. Transition must avoid activities prohibited in Islam like gambling, alcohol, pork, and interest-based transactions. For the conventional products, it is primarily profit-driven with no restrictions on the nature of activities except as regulated about secular news. Next point is prohibition of interest. Interest means riba. Okay, in Islamic product, prohibition of interest means riba. Earning or paying interest riba is strictly prohibited. Plus, they use profit sharing, leasing, or trade-based models like murabahah, mudarabah, and ijarah. For the conventional products, interest is a key component, whereas banking earn by charging interest on loans and pay interest on deposit. Next, I will talk about the next point is risk sharing in Islamic product. Islamic product promote risk sharing between parties. For example, in musyarakah, profits and losses are shared based on pre-agreed relations. By the way, while in the conventional products, the risk is usually borne by the borrower with fixed obligations to repay principal and interest regardless of the outcome of the venture. For the next, the point number 4 is asset backing. In Islamic product, require transaction to be backed by tangible assets or services. This ensures that money is tied to real economic activities. In the conventional products, loan and other financial instruments can be created without direct linkage to real asset. And the next point is ethical investment. So in Islamic product, investment must comply with Islamic ethics, excluding industry like alcohol, gambling, or pornography. So in the conventional products, there's no specific ethical restrictions allowing investment in broader range of industries. So the point number 6 is contracts. Basically, in Islamic product, there's a structure around specific contracts such as like murabahah means cost plus financing. Ijarah means leasing. Musyarakah means partnership, and takaful is Islamic insurance. So basically, in Islamic product, for the contract, in the Islamic product, about the contract must have one of these four specific contract like murabahah, ijarah, musyarakah, and takaful. So next we go to the conventional products. In the conventional products, the contracts are flexible and may include unsecured loans, overdraft, and traditional insurance. Okay, then I will talk about the next point. And then it was the next point is uncertainty and speculation means gharar. Okay, in Islamic product, prohibited excessive uncertainty which means gharar, and speculative transaction. And in the conventional products, it is allow speculative activities like derivatives, options, and short selling. Next, for the insurance, In the Islamic products, their penalties for late payments are typically donated to charity, as earning profit from penalties is not allowed. But in the commercial products, penalties for default are treated as an income source for the lender. So the point number 9 is penalty for default. So basically, in Islamic products, penalty for late payments are typically donated to charity, as earning profit from penalties is not allowed. In the conventional products, penalty for default are treated as an income source for the lender. And then the last point is social responsibility. So in Islamic products, there's a promote social justice, economic stability, and welfare through redistribution of wealth. Charity means zakat and ethical practices. But in the conventional products more focus on maximizing shareholders' value with limited emphasis on social responsibility. But last but not least, these differences reflect the core ethos of Islamic finance, which aims to balance economic growth with ethical and moral considerations. And with these differences also, it can contrasting with the profit to centric approach of conventional finance. So that's all from me. Thank you so much.
Okay. Hi, my name is Wan Abdul Azim bin Wan Abdul Arif. My metric number is 301369. So now I will explain to you what is lacking in the education financing PDS by both Islamic bank and conventional bank, and how Islam view regarding to this issue. Okay, first we take a look at the Bank Rakyat, which is Islamic bank. The BDS of education financing by Bank Rakyat has murabahah in it, which means we need to include extra payment on profit cost because of our purchase of the commodity from the bank. Okay, I will tell you like this. Mm, we make an education financing by with the bank, right? And then we need to also buy commodity from the bank. And so when we make a payment back to the bank, we need to pay education financing as installment. Okay, that's usual. Then we need to pay also the commodity as extra payment. We take a look at the table at the bottom. Monthly installment that made by us is by education financing itself. And then we need to pay total profit cost at the end of the year. What is the total profit? The total profit is when we make the payment for the commodity itself. So this bank doesn't include the option to not buy the commodity when we make the education financing. So what will happen here? So when people make education financing, they didn't expect they need to buy the commodity also. So if the bank giving us option to not buy the commodity, they need to put it in the PDS so that we know we can choose either we want to buy the commodity or not. So we didn't have to pay extra payment when we pay back to the bank. So like Islam told us how we need to put transparency in all of our contract so that we can make a contract more quality. So that's all. Okay, so after we see what is lacking in PDS education financing of Islamic Bank, which is Bank Rakyat, we need to also see what is lacking in the PDS education financing by conventional bank, which is Maybank, and how Islam view regarding to this issue. And what is lacking is that the PDS, the education financing PDS by conventional bank include riba in it, which is interest. As you can see in my bank PDS, the education financing, they include interest in it when making our payment, which is considered haram in Islam. As you can see below, that I put the table below, which is our obligation to uh, pay back to the bank after we make the education financing. So the first items is monthly installment. The monthly installment is usual because we make an education financing. That's why we need to pay back with monthly installment. But then at the second column, they told us to pay the interest cost. So when we make financing like 10,000 ringgit, then when we pay back to them, we're going to pay back more, like 20,000 ringgit because of the interest cost. So that is haram in Islam. Like Allah said in Al-Quran, wa ahallallahu al-bai'a wa harrama riba, which means Allah permitted buy and sell, but he prohibited riba, which is interest in bank statement. Okay, so that's all the problem that is happening in the PDS education financing.
Hi, my name is Nur M. Binti Fuad. My metric number is 300027. I will explain about the methodology in Maybank and Bank Rakyat PDS. In Maybank Education Financing Secured is designed to provide financial support for students pursuing higher education. This facility allows borrowers to secure loans based on the value of their collateral, which determines the margin of financing. For property, the MOF is up to 120% of the market value. For fixed deposit, it is up to 150%, and for Amanah Saham Bumiputra ASB, it is up to 67% of the certificate value. Borrowers are required to provide acceptable collateral to secure the loan, which could include property, FD, and ASB units. The effective interest rate is calculated as the standardized base rate (SBR) plus a margin rate determined by the type of collateral used. The SBR itself is tied to the overnight policy rate and changes when OPR is adjusted. This linkage means that variations in the OPR directly influence the SBR, affecting the loan's repayment terms. For example, a 1% increase in the SBR leads to a proportional increase in the effective interest rate, thereby raising the monthly installment amount and the total repayment cost over the loan tenure. Borrowers should be aware of the potential variability, as even small adjustment in the SBR can have significant long-term financial implications. Monthly installments are calculated using a standard formula based on the slide I show. Students are granted grace period during their studies, allowing them to defer principal repayments. However, interest continues to accrue during this time, which increases the total repayment amount once regular installment begin. The grace period provides flexibility but requires borrowers to plan carefully for the post-study repayment phase. The value of collateral is central to determining the financing offered. Property can secure an MOF up to 120%, FD up to 150%, and ASB up to 67%. This valuation ensures that borrowers have sufficient borrowing power while mitigating risk for the bank. Risk mitigation is further strengthened through measures such as late payment charges of 1% per annum on overdue amount and a default interest rate of SBR plus 6.15% for non-compliance. This mechanism helps ensure that borrowers meet their repayment obligation consistently. The dynamic nature of the SPR necessitates that borrowers remain vigilant about potential changes in their repayment obligation. For instance, in an illustrative scenario, a borrower with an initial effective rate of 4.85% might face increased monthly payments in the SPR rises by 1%, pushing the effective rate to 5.85%. Over a long tenure, such changes can significantly affect the total repayment amount, emphasizing the importance of understanding the impact of rate fluctuations. For Bank Rakyat's Murabahah Tawarruk Financing I provides a Sharia compliant solution for various financial needs, including education. These financing structures operate on the principle of Murabahah and Tawarruk, ensuring compliance with Islamic finance guidelines. Murabahah involves the bank purchasing a commodity such as For Bank Rakyat's Murabahah Tawarruk Financing I provides a Sharia compliance solutions for various financial needs, including education. These financing structures operate on the principle of Murabahah and Tawarruk, ensuring compliance with Islamic finance guidelines. Murabahah involves the bank purchasing a commodity and selling it to the customer at a cost plus a profit margin on a deferred payment basis. Tawarruk then facilitates the sale of the commodity to a third-party buyer for cash, which is deposited into the customer's account for immediate use. The total financing amount is determined by approved costs such as tuition or other related expenses, and the total selling price includes the finance amount plus the bank's profit. The profit rate is calculated based on the standardized base rate SPR, which is linked to Malaysia's overnight policy rate OPR, and a margin or spread set by the bank. This creates an effective profit rate formula, which is SPR plus margin or spread. As the SPR fluctuates, so does the profit rates, directly affecting monthly payments and the overall cost of financing. Monthly payments are based on the financing amount, tenure, and the effective profit rate. Borrowers should be aware that any changes in the SPR will lead to adjustment in their monthly installments and total repayment amounts. For example, if the SPR rises, the new profit rate will increase, resulting in higher monthly payments and a greater total financing cost. This variability requires careful financial planning to manage potential rates or changes into the financing period. The PDS also outlines various fees and charges, including a 0.5% stamp duty, legal fees for documentation, valuation fees if property is used as collateral, and custodian fees for securing documents after full settlement. Late payments are subject to penalties, which may reach up to 1% annually on overdue amounts during the financing period, or be calculated based on the Islamic interbank money market rate after termination or judgment. Early settlement is permissible with rebates, which is IBRA, applied to deferred profits. The early settlement formula includes the outstanding selling price in minus IBRA, plus any applicable rate payment charges. Collateral and guarantors may be required, and takaful coverage is highly recommended to protect against risks such as death or permanent disability. Takaful plans can be selected from Bank Rakyat's panel or any approved operator in Malaysia. Bank Rakyat's Murabahah Tawarruk Financing I offers a transparent Sharia-compliant solution for a variety of financial needs, ensuring ethical financial practices while allowing for flexibility in financing. Borrowers are encouraged to monitor changes in the SPR to manage their payments effectively, and early communication with the bank is recommended to explore alternative payment operation if necessary.
Hello, my name is Nur Afika binti Buang and my metric number is 300198. I will make a simple discussion and a conclusion, including a suggestion for future improvement for both banks. I will make a simple discussion about Islamic education financing by BIFCK2013. As we know, BIFCK2013 offers Sharia compliant financing based on Islamic principles, making it a suitable option for Muslims who want to avoid interest-based transaction. Here, how it works. First, Sharia principles based contracts. BIFCK2013's education financing use contracts such as murabaha and ijara, which comply with Islamic law. This contract avoid the use of interest and uncertainty. Instead of the interest, the bank makes its profit by adding a margin to the base rate, which is agreed upon in advance. Second, loan amount based on collateral. The amount of loan a student can get from Bank Rakyat is also based on the value of the collateral they provide, such as property, fixed deposit, or amanah saham Bumi Putera units. The bank will lend a certain percentage of the collateral value. For property, the financing limit can be up to 120% of the property value. For fixed deposit, the financing limit can be up to 150 of the FD value, and for ASP units, the financing limit can be up to 67 of the ASP unit value. Next, profit margin instead of interest. The financing is based on SPR plus a margin specific to the type of collateral provided. This rate is agreed upon at the beginning, and there is no fluctuation due to the market condition, which provides greater financial certainty for borrowers. Next, charity for late payments penalties. Unlike conventional loan, if a borrower misses a payment, the penalty is donated to charity rather than being kept as profit by bank. This is ethical approach in line with Islamic principles, which prohibited profiting from other misfortune. Next, conventional education financing by Maybank. As we know, Maybank provide education financing based on the standardized base rate SPR, which is a common model in conventional financing. And here are the key details. First, interest rate based on SPR. The interest rate for Maybank education loan is determined by the SPR plus a margin. The SPR is influenced by Malaysia Central Bank's overnight policy rate or PR, which can fluctuate based on the country economic condition. As a result, the interest rate may increase or decrease, affecting the monthly payments and total loan repayments. Second, grace period during studies. One of the feature of this loan is that the student do not need to pay the principal amount during their study period. However, interest continues to accumulate during this period, and this can lead to higher repayments as the student graduates. The grace period helps students focus on their studies, but it also means that the overall loan amount increases over time. Next, loan amount based on collateral. The loan amount you can borrow depends on the value of the collateral you provide. The collateral could be property, fixed deposit, or other assets, and the bank will lend you a certain percentage of the collateral value. This means the amount of loan you can receive is limited by the collateral you have. Next, here's some solution for future improvement for Bank Rakyat. To enhance the effectiveness and accessibility of Islamic financing product, here's some several improvements can be implemented by Bank Rakyat. Firstly, the explanation how the profit rate is calculated should be simplified and clarified. This can be achieved by incorporating illustration or real-life example in the product disclosure sheet PDS, helping consumer better understand the financial implication of their financing options. Secondly, greater transparency is needed regarding additional costs such as processing or administrative fees. Clear and detailed information should be provided upfront to ensure consumers are fully aware of all expenses associated with the financing products. To enhance the appeal of financial products, here's some several steps can be taken by Maybank. Firstly, introduce ethical product alternatives that combine both conventional and Islamic financing principles. This approach can cater to a broader customer base, including those seeking a balance between modern financial options and universal ethical values. Secondly, increase transparency in interest rate structure. Financial institutions should provide clear disclosure on how interest rates are calculated, particularly concerning change in market conditions. By offering more detailed explanation, consumers can better understand how market fluctuations affect their payments and make more informed financial product or financial decisions. Next, to better support students in managing their education financing, here's some following improvement can be considered by both banks. Firstly, offer more flexible repayment options that take into account student financial circumstance. This could include providing grace periods after graduation, allowing student time to secure stable employment before starting repayments, or implementing income-linked repayment schedule that adjusts based on their earning capacity. Such measures can ease the financial burden and encourage timely repayments. Secondly, provide financial literacy tools to empower students in making informed decisions about their financing options. These tools should focus on helping students understand the long-term financial impact of their loans, including total repayment costs, interest implication, and potential financial planning strategies. By enhancing financial literacy, students can make better choices that align with their future. Next, conclusion. The comparison between Rakyat Islamic financing and Maybank conventional education loans highlight that the fundamental differences in approach, structure, and values. Islamic financing emphasizes ethical consideration, fairness, and risk sharing, making it ideal for borrowers seeking compliance with Sharia principles. However, concepts around profit margin, transparency, and accessibility to criteria requirements remain challenges. Meanwhile, conventional products such as those offered by Maybank provide greater flexibility and are widely accessible but are heavily reliant on interest, raising ethical concerns or Muslim borrowers. The structure interest, the rate adjustment, and penalties offer clarity but can increase financial burdens during economic shift.